Hey, thanks a lot for joining us for A Better Way to Invest, an overview of goal-based planning and investing. Now, what we found is that through a goal-based planning and investing program, investors can create an effective guide that'll help them identify and then prioritize the financial and life goals that they're trying to reach before creating a customized investment plan to meet them. So with that in place, it's much easier to stay on track and it's much easier for investors to stay disciplined to reaching their goals. So what are the benefits? What are the advantages of goal-based planning and investing? Well, quite simply, it'll give you a better view of your future. Most of us, for example, are familiar with a retirement portfolio where our investments might be broken into equities and bonds. And unfortunately, traditional financial planning not only focuses on this, but usually consists of this one portfolio. But that's not how we live, is it? Compare that to a goal-based portfolio that includes retirement, but it also includes things such as a college fund, down payment for a house or relocation, family vacations, a cabin, a new car, anything that you might be working toward. With a goal-based portfolio plan, once again, you can see how your goals are going to be met as you continue through your life. Now, the first question is, how do we begin? It's real simple. Identify your goals. And by that I mean, what do you really want? Rather than just making a list, however, we found that by using a certain framework, it becomes much easier to clarify and to answer that question. The framework we use is the same one that we use when working with a company to set up their strategic plan, the SMART framework. Your goals then should be specific, measurable. How much will you need for that goal? Action oriented. What do you need to do? What steps do you need to take to reach it? Is it reasonable? Can you actually do those actions? Are they realistic? Are they doable? And timed. When do you need to reach that goal? Say for example, we have a couple that wants to save for a house, and that's going to be their specific goal. They want to save money for a down payment on a house, and after looking at the market, they thought, we need at least $60,000 for this, and we'd like to have it in 5 years. So what steps do they need to take? Well, after talking to their advisor, they found that if they could save $900 a month in a taxable account that was able to provide a 6% return, they would have their money, the money that they need. And because of the promotion that they received at work, they could absolutely expect to reach this goal. They had a baby and they wanted to have a new goal. This time, they want to save money for their child's college. They did some thought and they realized that they didn't really know what college is going to cost in 18 years, but they at least want to have $100,000 set aside. So what do they need to do? Well, they have a couple of options. They could open up a taxable account, in which case they would need to put in $325 a month with the expectation of getting or the hope of getting a 6% return. Or if they opened up a 529 plan, a tax-deferred account for college, they would only have to put aside $255 a month, again over 18 years with an expected return of 6%. Well, that was absolutely doable for this couple, and they know that they wanted the money when the child goes to college 18 years later. So as you can see, we've identified the goals, but that's just the first step. Now we need to prioritize them in the sense of what's important and also when they're needed. We do this by using this very simple model. Now you can see in box 1 and 2, Our high priority goals are going to be listed in terms of whether they're short term, which might be 0 to 5 years or 6 or 7 or 8 years, whatever you decide, or longer term. And in box 3 and 4, we have lower priority or aspirational goals, again, whether or not they're short term or long term. Now, low priority goal doesn't necessarily mean that it's not important. It just means that if they're not met, we'll be disappointed, but we won't be devastated. So if we keep that in mind, it'll help us to begin the prioritization process. For example, let's start with our couple. They want to save up for a house. That's a big priority. It's a big need for them. And it's a short time frame, so we put that in box 1. College funding is also a high priority, but with an 18-year time frame, we'll put that in box 2. High priority, low time frame. Now, the couple is working. They're both investing in their company 401k, so they're making a retirement portfolio, but once again, a long time frame, high priority. Well, in going through this process, the couple began to think and realize that they're pretty active. They like the outdoors. They like to hike. They like to camp. But what they'd really love is to one day have a cabin in the mountains, some kind of a retreat. Now, they know that that's a low priority. If they don't get it, their life won't be devastated. They also know that's pretty far down the road, so they put that in box 4. Closer, however, they would like to someday take a family vacation. It could be to Disneyland or could be to the beach. It's a low priority. Once again, it's important, but if they don't take the vacation, the family unit won't be devastated. They'll be disappointed. It may not be the dream vacation, it may be something else, and it's about 7 or 8 years away, so it's in a fairly short time frame. They put that in box 3. Now, what happens over time is that those goals are going to change. For example, we paid for the house, but now we need a car. And so in saving up for the car, they put together another investment portfolio. Again, it's going to be a high priority. They have to be able to take their kids around. They need a car, and it's a short time frame. The college fund, which was way out there in 18 years, is now much closer as a child enters junior high or senior high. So we've changed the time frame, even though we've kept that as a priority. Retirement is still pretty far out there. Cabin in the woods, they would still love to have that, but the couple has taken the family vacation, and so they've taken that out of their grid. So now what? Now comes the tricky part. We have our goals, we've prioritized them. We need to create a goal-based portfolio for each one of those priorities. Using the same prioritization grid, we can see that the high priority items are going to be invested somewhat conservatively. The short time frames, high priority short time items in box 1 might be invested pretty conservatively. Why? If the market declines, we may not have enough time to recover, for the market to recover, and that could have an impact on our portfolio. Consequently, we'll invest here in maybe treasury bills, maybe in some municipal bonds, something within a short that's pretty conservative. We don't want to lose money. We would love to be able to stay ahead of inflation. Now, our high priority goals with a longer time frame, they're going to be invested maybe less conservatively than are those in the box 1. Now, what does this mean? Because they would have a longer time to recover should the market decline, we may put in some quality equities. We might put in some dividend equities. We might have some different kinds of bonds. We're not going to roll the dice on our college funding, but again, we want to see some growth. Now, on our low priority items, again, will be even more aggressive depending on how important they are and how far away they are to reaching them. In practical terms, our down payment for our house portfolio is going to be very protected. Will be protected, but we want to give it some room to grow within the constructs of the amount of risk we want to carry, the time that we have. Now that's going to change once again over time as we draw closer to when we need that fund. That portfolio will become even more conservative than it started out to be. Because retirement is so far away, we may begin with a pretty aggressive portfolio that, once again, as we draw closer to our retirement age, it'll become more conservative. So again, as you can see, we are not doing buy, hold, and pray for the best in these. We're really making the adjustments that we need that reflect the timing and the importance of your portfolio. Finally, we have to measure and adjust. In other words, we have to stay on track of where these portfolios are with relation to their ability to meet our goals. Now, how do we do this? We use a pretty simple model that measures the likelihood of funding for all of our goals. And as you can see, the primary things that we look at, areas we look at, is whether or not our goals are below the confidence zone. That means we don't think we can get there. We're not comfortable in our ability to get there. Or inside of the confidence zone. We're pretty confident that we can get there, and if things change, we realize that we could probably make the adjustments we need to stay on track. Now, what does this look like in real life? Here's a couple that had a current goal of retiring early. They wanted to be active in their retirement. They wanted to travel and enjoy some of the things and go to some of the places that work hasn't allowed them to do. They live in the north and are quite frankly tired of winter, so they'd love to buy a condo in Miami. They want to make sure their medical needs are met in retirement. Their youngest daughter is still at home, so they want to complete the college funding that she needs for her college. And when they retire, they would love to have an income that is at least $150,000 in today's wages, adjusted for inflation. As we ran those goals through our analysis, we found that they just have almost a 50-50 chance of reaching them, which was far less than what the couple was comfortable with. So we began to talk about different ways to make some adjustments. What can we do? What if we retired later? What if we didn't travel? What if we didn't have a condo? What if our daughter got a soccer scholarship? What if we lowered our income? What if we did this? What if we did that? Well, as we applied or talked about different options, we came up with something that looked like this. The couple agreed that they could probably retire later. They didn't not like their jobs. They just liked the appeal of doing nothing or not having to work. But if they retired later, they could still travel. And instead of buying a condo in Miami where real estate is high, they thought if they retired in the Southwest where real estate was a little bit more affordable, it would still meet their goal of getting away from winter. They still had their medical needs, college funding, and retirement income. But with these changes, they saw that they could have a probability of success that was well inside of the comfort zone, the confidence zone. They had a 78% probability of reaching these goals. Well, that gave them a great peace of mind as they could continue on the plan that they had started with. But as we looked at this, they had one more question. If we're going to work longer, would we be able to remodel our house? And so we put this goal inside of that goal-based portfolio, that aggregate portfolio, And we ran the same analysis, and we found that they actually could remodel the house and retire later and travel and have a condo and the medical needs, college funding, income, and it would only slightly it would have only a slight impact on their probability of success. In other words, it went from 78% to 76%, but it's still well within the confidence zone. So the couple was able not only to meet their adjusted goals, but also add one that they had thought about, but they hadn't really thought that they could attain. Now the question, is it worth it? Is a goal-based plan and investment portfolio, customized portfolio, worth it? And we say it is. First, investors have a greater clarity, a greater understanding of what they're actually shooting for. Secondly, it gives them confidence and a peace of mind that some of these milestones that are important to their lives are actually being considered and addressed. Thirdly, as they draw closer to these goals, it gives them the discipline that they need to stay focused and to stay on track. And then number 4, as some of these goals are met, because again, the timing is different for each one, they're able to enjoy the rewards of their discipline and enjoy those things that are important to them. Well, again, thanks for watching. I'm Paul with Clearstone Wealth Management. We do goal-based planning and custom portfolio creation because we know that your finances, your investments, your goals are important to you. We do personal wealth management, not traditional, personal wealth management. My contact information is on the right. I'd love to hear from you. Drop me a line. If you want to talk, let me know. We'll set up a time. Meanwhile, once again, thanks so much for watching.